Hello everyone. Welcome back to the channel. Today we're going to break down a very important accounting concept that many students find confusing at first: depreciation of fixed assets. If you've ever wondered why we reduce the value of equipment every year, whether depreciation means money is leaving the business, or how to calculate depreciation using different methods, then this lesson is exactly what you need. Let's begin. 1. What is depreciation? Depreciation is the systematic allocation of the cost of a fixed asset over its useful life. Let me simplify that. When a business buys a long-term asset like machinery, vehicles, furniture, buildings, computers, the asset will be used for several years, not just 1 year. So instead of recording the entire cost as an expense immediately, accounting spreads the cost over the years the asset helps generate revenue. That spreading process is called depreciation. 2. Why do we depreciate assets? There are 3 major reasons. 1. Matching principle. Under accounting principles, expenses should be matched with the revenue they help generate. If a machine helps produce goods for 5 years, we should spread its cost across those 5 years. 2. Asset wear and tear. Most fixed assets lose value over time because of usage, wear and tear, obsolescence, technological changes. 3. True financial position. Depreciation ensures that assets are not overstated on the balance sheet. Without depreciation, assets would remain at their original cost forever, which would be unrealistic. 3. Important terms you must know. Before calculating depreciation, understand these 4 key terms. 1. Cost of asset. The purchase price plus all expenses needed to bring the asset into use. Example: if a machine costs $10,000 and installation costs $1,000. Total cost equals $11,000. 2. Useful life. The estimated period the asset will be used. Example: 5 years. 3. Residual value, also known as salvage value. The estimated value of the asset at the end of its useful life. Example: $1,000. 4. Depreciable amount. Cost minus residual value. If cost equals $11,000, residual value equals $1,000. Depreciable amount equals $10,000. This is the amount we spread over the useful life. 4. Depreciation does not mean cash is paid. Very important. Depreciation is a non-cash expense. The cash was already paid when the asset was purchased. Depreciation is simply an accounting adjustment to allocate cost. That's why in the cash flow statement, depreciation is added back when calculating operating cash flow. 5. Main methods of depreciation. Now let's discuss the most common methods. Method 1. Straight line method. This is the simplest and most popular method. Formula: depreciation per year equals cost minus residual value divided by useful life. Example: cost equals $11,000. Residual value equals $1,000. Useful life equals 5 years. Depreciation equals 11,000 minus 1,000 divided by 5 equals 10,000 divided by 5 equals $2,000 per year. Every year, the business records $2,000 as depreciation expense. Simple and consistent. Method 2. Reducing balance method or declining balance. Here, depreciation is charged as a percentage of the book value each year. That means higher depreciation in early years, lower depreciation in later years. Example: cost equals $10,000. Rate equals 20%. Year 1. 20% times 10,000 is equal to 2,000. Book value becomes 8,000. Year 2. 20% times 8,000 is equal to 1,600. Book value becomes 6,400. And so on. This method is suitable for assets that lose value quickly, like vehicles or computers. Method 3. Units of production method. Depreciation is based on actual usage. Formula: depreciation per unit equals cost minus residual value divided by total estimated units. If total estimated production equals 100,000 units and depreciable amount equals $10,000, depreciation per unit equals 10 cents per unit. If 20,000 units are produced this year, depreciation equals 20,000 times 0.10 equals $2,000. This method is ideal for machinery used based on output. 6. Journal entry for depreciation. At the end of each accounting period, we record debit, depreciation expense, Credit. Accumulated depreciation. Accumulated depreciation is a contra-asset account. It reduces the asset's book value. 7. How depreciation appears in financial statements. 1. Income statement. Depreciation appears as an expense. It reduces profit. 2. Balance sheet. The asset is shown at cost minus accumulated depreciation equals net book value. Example, machine $11,000. Accumulated depreciation, $4,000. Net book value, $7,000. 8. What depreciation is not? Depreciation is not a market value adjustment, a savings fund, a cash reserve, a valuation method. It is simply cost allocation. 9. Factors affecting depreciation. Nature of the asset, expected usage, maintenance policy, technological change, legal or contractual limits. 10. Common mistakes students make. Thinking depreciation means asset is worthless. Forgetting to subtract residual value. Confusing book value with market value. Forgetting accumulated depreciation reduces asset value. Conclusion. Let's quickly recap. Depreciation is the systematic allocation of asset cost based on useful life, a non-cash expense, recorded annually, essential for accurate financial reporting. Understanding depreciation is crucial because it affects profit, asset valuation, tax calculations, investment decisions. In the next lesson, we'll take practical real-life transactions and record depreciation step by step. If this explanation helped you understand depreciation clearly, don't forget to like the video, subscribe, and share with other accounting students. See you in the next class.